Welcome to this video brought to you by ASWATAX from sunny Saudi Arabia. What time is it? 4:41. Absolutely gorgeous, absolutely beautiful. I'm just sat here posted with my daughter in the back. She's just playing on my phone. She's had a McFlurry, and my other daughter's gone to gymnastics, so we'll be waiting for another 20 minutes. So I thought I'll shoot this quick video in terms of a client we have in relation to a capital reduction demerger case. Now, before we go on, don't forget to like, comment, share and subscribe to our channel, and don't forget to reach out if you'd like our specialist tax support. First of all, there are three types of demergers mainly. Statutory demergers, which don't work when it comes to properties or investment companies. Then we have a capital reduction demerger, which is or have gained a lot of popularity in the last 10 years or so due to some changes in the rules and the rest of it. And number three, we have liquidation demergers, which are not that popular because of the negative connotations surrounding liquidation. Now, undertaking demergers are extremely complex transactions. There's a whole list of steps that you need to go through, or that we need to support you with, and anything that goes wrong. So there's two angles. Anything that goes wrong in any of these steps, and you'll trigger unnecessary capital gains tax liabilities, perhaps stamp duty, land tax, corporation tax, income tax on the shareholders. You'll end up activating certain liabilities which could have been avoided. And the second aspect is that these steps must be undertaken accurately and comprehensively, meaning I've seen many a time where massive planning opportunities have been missed out, whether it comes to capital, particularly as in the example that I'm currently thinking of, is we're looking at both capital gains tax and stamp duty land tax. So we have this particular client, 3 shareholders, 70%. She's 70% because she's like the most active within the business, and then is 25% her sister and 5% her brother. Now, this company was incorporated back in the 1980s. So they've been running a travel agency for a long time in London, Stoke Newington in London. And they've been operating from a mixed property, so commercial at the bottom, residential at the top. And they've been operating from this property for over 20 years now, since it was purchased over 20 years ago. And the market value of the property today is £1.9 million, and the base cost is in the region of £150,000 to £200,000. So there's a few issues here. Number one is we know, from a very high level, the figures, even if you say 1.9 take away 200,000 is 1.7 million capital gain on the property, on the mixed use property. Now, the objectives of the client is that they are looking to either sell or close up trade, which is the travel agency. But the initial issue is that, or the objective is that they want to now use this property for passive income. Because since COVID, all their staff are working remote. So you need to remember that the bottom part of the property was used as the trading premises for the travel agency business. The overarching objectives are that they want to use this property. Rest, baby. You can have a lie down, okay? They want to use this property for passive income, and they are fully aware of the inheritance tax implications or the potential liability that sits with this £1.9 million trading premises and residential on top. And they also have some other plans as well, and some other ideas around, Airbnb and that kind of thing. But obviously that's not something we get directly involved with, but we just need to, from our side, we need to understand exactly what the client's objectives are. So many times I tell clients that technically we can do so many different things for you, but there's no point in me throwing out like 50 solutions and I'm just throwing out solutions. It's the other way around. We need to understand your exact objectives, and then we tailor the transaction tax efficiently so that your objectives are met effectively, tax efficiently. So I'm pleased to say that we have received clearance from HMRC on the capital reduction demerger, and prior to obtaining clearance, we've already mapped out the exact steps. So now we'll be moving on to the legal implementation. In terms of the tax savings, we've easily saved the client. I can't remember because we engaged this client about 3 months ago, but it's easily in the region. I think it's in the region of £400,000. So, it's a massive win for the client. Sorry, that was the capital gains tax. It was around £800,000 when we're looking at some other angles as well. So a capital reduction demerger is a powerful tool, a powerful mechanism that can be used to split a trade from investment properties. It can also be used where you have a property investment company itself and you need to split it between multiple shareholders or families. These are all areas that we regularly get involved in. I have another client that's coming on board, 2 families. Their portfolio together jointly is worth around £7 million. It's amicable. There's no issue between the 2 families. They're still very, very close, and they built up this portfolio for about 25 years. Plus, the 2 initial partners of the property investment company, they're both chartered accountants, so they run a successful accountancy practice in Scotland. And as you grow, as your family grows, the business grows, the investment business grows, the family grows, different people get involved. At a certain point, it makes sense to now go separate ways. Now, if they don't take tax advice and if they don't do things properly with expert advice, they will miss opportunities, number one. Or even before missing opportunities, they'll end up paying hefty tax bills. I'm talking about like hundreds of thousands, if not millions, because capital gains tax and stamp duty land tax are significant. And perhaps corporation tax as well. So it's very important to take advice. We haven't mapped out the steps yet for these particular clients. The first step that we'll be involved in is around how exactly, as in which properties are going to be split, which family receives which properties, and we have an angle whereby we are looking to keep some of the properties jointly, both because one of the partners asked me if they could do that, and that's something they were thinking of, but more importantly, we were thinking of it from our side anyway, which is that it will strengthen the case in order to obtain clearance, so that, as in one of the conditions is that it's for the transaction. I'm talking about the commercial rationale from that perspective. So it's all fun and games, and it's all looking good. Please do reach out if you require our support when it comes to capital reduction demergers, even statutory demergers. I'm speaking to another client on that angle as well. These are complex transactions, but we're very confident in them just because we've been dealing with them for a long time now. And I personally, my colleagues, we like to think outside the box. I think that's very important when it comes to tax planning. I see many of these larger firms, they very basic, like their thinking is very basic. It might do the job, but it's like there's no further thought, right? Inheritance tax planning we look after in-house, and property tax, commercial property, SAS pension funds. Anything you need, please reach out. Omar at ASWATAX.co.uk. We are chartered tax advisors regulated by the Chartered Institute of Taxation. Don't forget to like, comment, share and subscribe, and see you on the next one. Thank you. Bye.